So let's get started with architecture trading. Now, tonight, I will use the term security when referring to any tradable financial instrument. This includes stocks, bonds, commodities, futures, indices, mutual funds, options, CFDs, and cryptocurrency. You know, what happens is it gets very, very boring just saying security or asset over and over again. So I mix up the words just to make, things more interesting. But we're talking about any tradable financial instrument. And because we're all here sponsored by TradeTime is the leading provider of Forex and CFDs. So we're really talking about Forex and CFDs. Similarly, I'm going to intermix the terms investing and trading. Now, I've gotten emails over the years from people saying, oh, but you're talking about trading. You're not talking about investing. Don't you know the difference? Yes, I know the difference. Typically, an investor takes a long-term position, while a trader takes a much shorter-term position. But in either case, the basic concepts and techniques presented in this class are equally adept. And again, to just say trading all night long gets very boring. So we use investing, trading, all kinds of terms, but we're talking about the same thing. Now, also, if you're sitting there asking your question, should I buy today? What will the prices be tomorrow, next week, or next year? Now, would investing be easy if we knew the answer to these seemingly simple questions? But the fact is, none of us have a crystal ball. So alas, if you're attending this class in the hopes that technical analysis has the answer to these questions, I'm afraid I have to disappoint you early. It doesn't. However, if you're attending this webinar with the hope that technical analysis, especially price action trading, will improve your investing or trading, I have good news for you. It will. Now, there are many large players in the Forex market, such as hedge funds and large banks, that all have advanced computer systems that constantly monitor any inconsistency between the different currencies and the different assets. Given these programs, it is rare to see a major consistency last more than a matter of seconds. Many traders turn to Forex technical analysis because it presumes that all the factors that influence price, economic, political, social, psychological, have all been factored into the current price. With so many traders and so much money exchanging hands each day, the trend in the flow of capital is what is important, rather than attempting to identify a mispriced rate. And the fact is, it's very difficult for us to be faster than all of those computers. So we have to look for a way that we can trade successfully. Now, trends and lines on a chart can help us with that. Okay. Remember, one of the major terms out there is the trend is your friend. But really, to become a successful trader, you need to use experimentation, determination, hard work, practice, individuality, practice some more hard work, repetition, observation, and more hard work. It's not an easy goal. Now, too many of us out there get ourselves so wrapped up in trying to figure out what assets to trade and coming up with systems and scanners and all of this stuff that we end up with these cluttered up charts and these cluttered up decision-making processes that make a mess and really don't help us increase our success rate at all. Ultimately, it becomes down to risk management, money management. Order entry types is really more important than any strategies. So having complicated trading strategies is probably one of the hindrances that we can have. Now, when I first started teaching a long time ago, I used to teach price action because it's my way of trading. I prayed charts, price action, and maybe some chart patterns, support and resistance. That is me 100%. It's always been my motto. Thing is, it becomes difficult or mind-boggling or confusing for a lot of traders to actually get involved in understanding really how to read a chart, how to see price action, what it's all about, how to see what is happening without using technical analysis and all these indicators and oscillators and mathematical calculations. So I started out trying to say, I teach my students, especially when I do especially when I do seminars and talking with new traders, is how can I explain and show you how to trade from price action on charts without making it scareful and difficult, with giving you things that you can understand, with things that you can actually build the story and see what's happening in price. And one day I realized when you look at support and resistance and price action, I could almost build a story about a or tell a story about an elevator going up and down in a 4-story office complex. And as I watched the charts and watched price and started to develop this theory in my head, I started to see more and more about different ways we could talk about price moving up and down like an elevator in a building or a different building. So we talk about 4-story buildings, mid-rise buildings, high-rise buildings, elevator trading, underground parking trading, basement trading. Because basically what it comes down to, a price can either be trending up, trending down, or trading sideways. Okay. So basement trading is like when it's fallen all the way down, it's the bottom of the downtrend. Well, how do you analyze? Well, we look at price falling down the basement and down the parking lot. It gives us a way that we can understand it. High-rise trading is when price shoots up in a hard trend. What could happen as price soars upward? Elevator trading is looking at how that elevator moves up and down and how price can tell that same story of this elevator. Now, see this chart over here? This is a very good example. I can tell you an entire story, and shortly, you're going to be able to tell me an entire story about how price moved in a 4-story building, or how the elevator moved in a 4-story building. So, I'm sorry, I know I'm hurting your eyes. So imagine this building that's up on your screen. Come on, one more, there we go. And what we have is a very busy office building, a small one, 4 stories, that's got a big retail stuff on the ground level. It's on a corner in a major metropolis where a bus stop and a subway are right there. Okay. So right away, we know that there's going to be lots of traffic in and out of that ground level. And when we stick our head in that ground level, we see a Starbucks. We see a place that's selling baked goods. We see a sandwich shop. We see lots of things that are be attracting people in and out, besides seeing boutiques and a couple other things. But we realize that there's going to be a lot of traffic on that ground level. People cutting from one side of the building to the other, picking up their coffee on their way down the street to get to work. Okay. A lot of foot flow going through that ground level. So we walk around and we explore in that ground level. And we notice an elevator. See the doors open to the elevator. Now, you step in the elevator, but you say you're just exploring, so you're not touching any buttons. The door closes and the elevator moves up a level. The doors open and you're staying in that elevator, but you look out, you peer around, and you see down that hallway, it's all dark wood, it's all high-end professional offices. So we had the ground level. Now, we have all these beautiful doctors, dentists, lawyers' office, black wood, carpet. But, not offices, they're nice offices, but not offices that have a lot of traffic flow. And not offices that are going to have lots of people coming and going, coming and going, coming and going. The lawyers and doctors will have appointments, they'll come in, they have their waiting rooms and whatever else. The elevator moves up to the next level, and we can see again there, it is offices, but it's really not like the second level, because what happens, a lot of these offices on the second level are closed off, and they have a stairway up to their own little, there's a law and a law office. They have the law library upstairs. They have but you enter their main office on the first floor, and you go up to the second. Elevator moves back in, moves up the next level, and we see that's all conference rooms. And you see signs hanging out there, conference whatever, and all in conference room A at 2:30. You see another sign up there, conference room B. This is going on at 4:30. Then the elevator goes up to the rooftop, and the doors open, and you can see there's lots of tables. There's outside smoking areas where people are going, and people working in the building are going to smoke. You see lunch tables, you see vending machines, you see coffee machines. And this is the building. Now, you're a smart guy. You're doing some calculations in your head only because you got time on your hands. And you realize, okay, there's also a basement down here. Elevator goes down from this floor all the way down to the basement. Door opens up, and you look outside, and you can see, it's a maintenance area. You can see the dumpsters. You can see the cages for the cleaning supplies. You see the bucket and the mop. You see the maintenance office. While you're standing there, the maintenance worker gets in with her bucket and mop, and she's going up to the first floor, pushes the button to the first floor, goes up to the first floor again. She gets off with her stuff to clean that floor because it's very early in the morning. Those lawyers and accountants aren't coming to work yet. But this is our 4-story building. Now, if you do some evaluation, some thinking, in the morning, depending on time of day, in the morning, 8:30, 9 o'clock, there's going to be lots of traffic to this floor right here. Floor 1, because all of those employees are starting to come to work. And even those that work on this floor have to come in through this level and then go up inside theirs. Conference rooms don't have anything scheduled, so when you saw the conference room scheduled, plus employees aren't coming to work. But once these employees start coming into work, we're going to start to see traffic going up to the smoking deck or the break room, the coffee machines, and everything else, because these employees, they're coming in the morning, they're putting their stuff in their office, and they're running upstairs to smoke their morning cigarette or get their morning cup of coffee or have their morning break. Well, if we think of prices as elevator, and we know the time of day, we know the economic events for the day because we're using our economics calendar, which is similar to the schedule on the wall to the conference rooms, we can then start to project as this elevator moves up and down, what are the odds it's going to stop and where it's going to stop. So we can calculate in the morning, it's going to take lots of trips to that first floor, few trips to the second floor, more trips to the third floor, very few trips to the third floor, and a lot of trips to the roof. If you're on that elevator, the roof deck, it's most likely going to come straight down here to the first level. But at 11:30 or between 10:30 and 11:30, we're going to see lots of traffic to the conference room because there's a big conference at 11:30. Lunchtime, we're going to see lots of traffic to the roof where employees that are working in the building can go up there and eat or smoke their cigarette again or have their drink. In the evening, the elevator is going to go very slow, so most likely in the evening, it's only going to go up to this level or that level. And then as it gets later, it's probably going to take more trips to the basement as the maintenance men and the trash, the cleaners and everything else start going from the basement up to clean the floors and empty the trash and all that kind of stuff. And what have I just described? Okay, and you may think this is long and not to the point, okay, or it has very little to do with your trading, but the fact is it does. Because look at this chart we have here. This is Euro-Japanese yen, and we can see starting in the morning, the elevator came up from the basement, came up to the ground level, went up to the first floor, came back down to the ground level, went up to the second level, came back down to the ground level, went up to that roof deck, came back to the ground level, went back to that second floor, went back to the first floor, went back to that roof, came back down to that ground level again, went back to the roof, came back to that first floor again, and is probably going to come back to the ground. Well, what do? We just explained how price was moving. Now, that's why we have lots of different buildings and lots of different elevator scenarios. But if you stop getting yourself confused and start trying to explain to yourself price action and looking at your charts and making a story of how price is moving, you'd be surprised because you can actually do most of your trading simply off of price action. Now, price action is my favorite indicator because it's the only one out there that never will tell you a lie. Because price action is ultimately everything that's all about. Doesn't matter what some indicator's telling you to do. Doesn't matter what some trend line's telling you to do. Doesn't matter what those 52 other signals. And the only thing that counts is price action and the movement on charts. Because the other things are only indicators. That's all they are. They're giving you some indication. So it's all up to you. It's all about being able to interpret price action. Now, price action is a form of technical analysis that focuses solely on past prices that have traded in the market. Price action trading is a discipline of making all of your decisions in trading from a clear price chart. This implies that there are no lagging FX or indicators, technical indicators present, except for perhaps maybe a moving average to help determine some dynamic resistance and support areas, along with trend direction as well. But everything is right on that current chart. Not all those indicators you stuck below. Not all those lines you're japping all over the place. Because what happens is you get it all so jumbled up, you can't even see what's really happening. All financial markets create data concerning the movement of price over varying time periods. And this data is demonstrated on price charts. Taking into account that price charts reflect the beliefs and actions of all market participants, either human or computer, trading a market during a particular period of time, and those beliefs are displayed on a market price chart in the form of price action. Since economic data and other world news and events are the catalyst for price movement in the market, we do not need to analyze them in order to trade the market successfully. All economic data and global news that cause price movements within a market are eventually reflected via price action on that market's price chart. Now, as a market's price action reflects all variables influencing the market for any given period of time, exploiting lagging indicators like MACD, which is one of my favorite indicators, the stochastics oscillator, the RSI, and others can sometimes be a waste of time. And truly, especially when you're trading in CFDs and Forex that are short-term, very fast-moving markets, that these indicators and oscillators may not be so helpful. And you can get lost in your chart can be so complex and convoluted that you don't see through the forest. There are traders who might say that price movement provides all the Forex price action signals that you will ever need to design a profitable and high probability trading system. Those signals are collectively known as price action trading strategies. And they deliver a way of making sense of the market's price movement, as well as assisting predicting its future movement with a high degree of accuracy in order to grant you a high probability trading strategy. And see, this is all we're ever looking for, is high probability trades. Now, surely most traders end up making it as a trader will find a specific study of technical analysis eventually. But it's usually only after multiple disappointments and failed attempts to build indicator-based strategies that zig when the markets actually zag. So please allow me to elaborate on my earlier statement. Price action will never lie to us as traders because it never purports to tell us what will happen, but rather it tells us only what has happened and what is happening. Simply put, price action is the footprint of money. Financial markets are where money is exchanged between market participants, and this exchange of money leaves a trail. This trail is the market's price movement or price action. And as we know, it can be observed in a price chart. As a Forex trader, CFD trader, it is vital to learn to define and trade from the clues left behind from price action because it makes a trail across the price charts. It is important to learn price action, not just for your general knowledge, but to amplify your trading arsenal in general. Earlier, we touched on the topic of price action trading strategies. We should admit that they form because price movement in the market have a tendency to be repetitive. Furthermore, price action trading encompasses price action strategies from three levels in the market. Sometimes you do not need to create a complex strategy. A plain price chart and some common sense can be enough. Additionally, by combining price action setups with hot points in the market, such as core support and resistance levels and dynamic resistance and support levels, you can learn to pick accurate entries that provide you the best chance of a high probability profitable trade. Price action strategy can be traded in any financial market or at any time frame you prefer. It's advisable that traders concentrate their efforts on trading higher time frames first, with the main time frame being a daily chart in particular. But the answer is simple. Why trade with price action? Price is the essence of the financial market. It resembles math. If you do not understand the term of the task, you will not be able to provide any solution. And what happens is we get so wrapped up in learning how to use MACD, RSI, stochastics, that those indicators could take years to master. I've been trading with MACD for over 25 years. Okay? And to learn all the little nuances of that takes many, many years. And I simply use it as, and this is where a big mistake is, technical indicators. Now, those things are called indicators or oscillators. They are a secondary confirmation tool. They should never be used directly for trading. They are what you use to confirm or infirm a trading decision. So every trader who tries to convince you that it's easy to trade from indicators or trading software other than price action indicators is unaware of the reality of the markets. The reality of the markets is that current price is the ultimate result of all the variables connected to the market. What is the point of concerning yourself with analyzing anything but this price movement? Traders tend to fall into traps of using unreliable indicators and robots simply because the people selling them exaggerate their effectiveness. To fully understand price action, it's important to comprehend that there is no easy way to make money in this world. Remember that any shortcuts that you believe you have found in the markets are merely temporary. By learning price action, you are giving yourself a better chance at a trading success. So let's take a look at my favorite price action strategies. Let's look at some of the price action trading strategies that I teach, and note that I've included a failed trade setup because not every trade will be a winner. So remember, for every trade, entry points, exit points, stop loss, risk management, those are the ultimate keys. You can find out no matter what and why you decide to enter a market. You're only going to be right a small percentage of the time and wrong a bigger percentage of the time. The whole idea is when you're wrong is to be able to get out of that market without losing your tail. The second thing is using risk management will keep you from making trades that you cannot afford to make. Because when your profit to loss ratio and your risk management tools, even though you're so sure that trade's going to be right, says you can't afford to make this trade. It's not going to bring back the profit level you need, or you have to set your stop loss beyond what you can afford to trade. You simply don't make the trade. Now, some of my favorite trading strategies is the inside pin bar combo, the failed pin bar, the failed bar continuation setup, the pin bar reversal setup, and the inside bar setup. Now, these are done with candlestick, a Japanese candlestick chart, but this has nothing to do with learning to read candlesticks. This is learning to see what the market is telling you in the price action on the chart, because each one of these candles shows you the open, the high, the low, and the close of a price. Okay. What it's doing in relationship to the next candle gives you a particular setup. So remember, when we're looking at an uptrend, higher highs and higher lows we can see, and we can actually circle them on our chart and see the higher wicks and of the candles and see them marching upward, because we only want to really trade price action in a developed uptrend or downtrend. Okay. When we're looking at an uptrend, okay, because again, we only want to find high probability trades. And as you know, the markets can do three things: uptrend, downtrends, and go sideways. Now, they can have well-developed uptrends and well-developed downtrends, or sloppy ones. The fact is, there's more than enough opportunities finding well-developed uptrends. So why trade the euro just because you think it's going to go up? No, if you don't see it in a well-developed uptrend or downtrend, go on to another asset. The more well-developed the trend is, the more likely when you make a trading decision, the more successful you'll be. So when we're looking at price consolidation, price moving sideways, it's a very difficult way to trade, because you're trading support and resistance and you're looking for price to bounce up. But when you can isolate an ultimate high point and an ultimate low point for that asset on the charts, the more times it approaches that price and can't get higher than that resistance level, or fall below that support level, the more it's stuck in that congestion range. And you might be able to, when you take your time to isolate it, you might be able to get in a couple trades as it moves up to and bounces off. But sooner or later, it's going to move into a trending action. So due to the repetitive nature of the market participants and the way they react to global economic variables, the price action of a market tends to repeat itself in various patterns. These patterns are also called price action trading strategies. And there are many different price action strategies traded in many ways. These reoccurring price patterns or price action setups reflect changes or continuations in market sentiment. In layman's terms, just means by learning to spot price action patterns, you can get clues as to where price might go next. So here, if we note the key levels of support and resistance, and if you don't understand what support and resistance is, you should come to one of our classes on support and resistance. Well, once we've isolated these support and resistance levels, because again, we are looking only at charts. You notice there's nothing down below here. We have no indicators and oscillators. We have very little. Our charts are clean. So the only thing we're looking at on our chart is we're going to draw on our support and resistance levels. And if you go to the link that I just gave you and look under, when you get the playlist, go under support and resistance. And there's several good short, just a couple of minute videos that in there that'll show you exactly how to isolate support and resistance. So once we've isolated, we would look for a certain type of reaction from the candlestick. So we can see the pin bar reversal. We can see the in-bar setup. We can see here the pin bar reversal again. When it comes up to resistance, we see the bulls pushed it up, couldn't hold that resistance, and the candle started to fall, or price started to fall off that resistance. We have a nice little trade in price action. Again, here we moved up to the resistance level. The close couldn't break it, and the bulls couldn't sustain it. Hold on, I just want to get my markings off here. So after we've isolated our support and resistance areas, the next major step in trading price action is to draw in the key chart levels and look for confluent levels to trade from. In the chart below, which we'll see in a second, I'll flip over to, we can see that an obvious and confluent pin bar setup formed in the USD JPY that kicked off a huge uptrend. Note that the pin bar setup showed rejection. So here we can see, if we're just looking at price action, this is a high-rise elevator. Price moved up to this resistance level, broke off of it, fell right back down to bounced off of it again. So we got the pin bar at the 50% Fibonacci support level and moved back up. This gave us a very good opportunity to enter the market long because price had already been moving up. We had a strong uptrend. Came back down to the 50% retracement and then shot off from that point forward. Now, all economic variables create price movement, which can be easily seen in market's price chart. Therefore, instead of trying to analyze a million economic variables each day, you can simply learn to trade price action because this style of trading allows you to emphasize and easily analyze and make sure the market varies by simply reading and trading from the price action trail they leave behind in the markets. So let's start with the very basics. In the chart here on the left, you'll see some of the basic technology. So when we talk about an up bar, each bar has a higher high and a higher low than the previous bar. So in other words, each one of the bodies of the candles was steadily marching upward. Now, we do have a red candle and a green candle or a black and white candle, but that's not important to us. All we can see is it's a steady march upward of the price. Here we have then the outside bar candle. Then we have the down bar candle, and the down bar candle, each price bar has a lower high and a lower low than the previous bar. So you have up bars, outside bars, inside bars, and down bars. That's it, 4 pieces of information. So note the term candle describes trading with candlestick charts. And you can see candle and bar used interchangeably because you can also use a bar chart to do the same thing. So an up bar or a bullish bar is a bar with a higher high and a higher low than the previous bar. The up bars marked above are in an uptrend. Generally, the close is higher than the open. But sometimes you can have a close lower than the open and it can still be an up bar. So again, the up bar is here. And like I said, even though you would have had a red candle in here, it didn't make a difference. It was still moving steadily up. Just happened to be in that time frame, that one candle, it opened higher than it closed, but it still kept the price moving up. So what we have is an up bar. A down bar or a bearish bar is a bar with a lower high and a lower low than the previous bar. So a down bar each bar was lower than the previous bar. Not complicated. Then we have an inside bar, which is also sometimes called a narrow range bar. An inside bar is a bar with a high that is lower than the previous bar's high and a low that is higher than the previous bar's low. Some traders do not consider an inside bar that has either an equal high or an equal low. Others do. Inside bars usually represent market indecision. So an inside bar, sorry, get my marker back on. So an inside bar is a lower low And so it's got a higher high and a lower inside the high and low of the previous bar. So you see how these high and low are within the price of the previous bar. So that's an inside bar. An outside bar, the high and the low are outside and the high and low of the next bar. So this would be your inside bar, that's your outside bar, and this is your inside bar. I'm just trying to clean up. There we go. So sometimes called a mother bar or an outside bar, wide range or engulfing bar. An outside bar is a bar or a candle with a high that is higher than the previous or the next bar, and with a low that is lower than the previous or the next bar. When the open is in the bottom quarter or third of the bar, and the close is in the top third of the bar, is said to be a bullish engulfing with buyers in control. Another definition used for this bar, an outside bar, especially if candlestick charts are used, is that the open and close have to engulf the previous bar's open and close. So as markets move, they leave behind what is called a footprint. This footprint is the price action, and it sometimes leaves clues in which direction it is heading next. These clues are known as price action trading signals. We are looking for these price action signals to give us some confirmation for an entry into the market. So in this example chart, okay, we can see the pin bar reversal setup. Okay. So the point in the market where one or two more levels intersect each other, thus forming a hot point or a confluence area. So this is when we get the candlestick set up as well as support and resistance levels, okay? Or we get confluence at a certain price where we had two or three different signals coming together. So basically, when we look for confluent areas in the market, we are looking for areas where two or more levels or analysis tools are intersecting. So in this chart we're going to look at, we've also combined a 8-period and 20-day moving average. And when we can see them come together or cross over, and we're also getting a pin bar signal, we have confluence. So we have here a resistance level from our support and resistance line. We have our pin bar set up, and we also have our moving average breaking that resistance line. So we have confluence. We have several factors on our price chart coming together at the same time. So trading price action with confluence, we have 1, downtrends, we have 2, rejection of horizontal resistance, and 3, rejection of dynamic resistance. So what do we have? We have a downtrend. 2, we have rejection of the horizontal resistance. Right here, we have the pin bar rejecting it. And 3, we have rejection of the dynamic resistance. The dynamic resistance came from the moving average. So this is another way to trade now with price action, where we just look for higher highs and higher lows on our candlesticks and draw them forward. And we can draw a whole bunch of these forward. In fact, if you look into support and resistance level, you can see videos I gave you. You can see an entire example of doing this entirely on your chart, grabbing them ahead of time, bringing them forward and putting them on your charts. But once you isolate these lower lows and lower highs and uptrend and downtrend and draw the line forward, they give you prices that could be important to the marketplace. So remember, trading with the trend is a rather general phrase that often causes confusion to beginning traders who do not yet have yet to find an effective strategy with trend trading. The way I trade with the trend is simply to look for one of my high probability price action trading setups to form with the daily chart trends, ideally from the confluence area within the trend. So in closing, you should now have a good understanding of the basics of price action trading. One thing that I didn't touch on is that what time frame you should begin learning to trade on. All charts in this lesson were made from daily charts. And it's important that you first learn how to trade from the daily charts before going to the lower time frames. The reason is simple. The daily charts give you the clearest and most accurate view of the market price action. And the lower time frames, you get some more market noise. But then for CFD trading, we need to get down to that 1 hour and 1 hour and a half hour charts. So you can quickly look at, try them out. It's easier to see them in slower moving charts, and then move over to the smaller time frames to trade your CFD and your Forex trading. Thank you very much for joining us tonight, and have a great trading night. And hopefully you learned something or have something to think about, and go to Trade Time. Their education section has a lot of this information for you. Have a good night now.